Welcome back, everyone. Next, we have Trillion Energy. It trades on the OTCQB under the symbol TRLEF and on the CSE under the symbol TCF, and is focused on natural gas production for Europe and Turkey with natural gas assets in Turkey and Bulgaria. Please welcome its CEO, Art Halleran. Welcome back, Art. How are you doing today?
I'm doing very well, and thanks for having me on here again.
Great. Well, it's important time now for natural gas, especially in Europe. So please give us your update, and we look forward to your presentation.
Okay, I sure will. So I'm Art. I'm the CEO of Trillion Energy, and we are actually commencing our natural gas project in Turkey. And this is one of our offshore platforms, and we have 17 wells we're going to be drilling. We trade on the CSE under the symbol TCF, Frankfurt Z62, and OTC on TRLEF. And we're just going to go through the disclaimers. So I'm going to give an update. A lot of people know Trillion, but just to set the stage here, who are we? We are an existing gas and oil producer in Turkey. And like I said, we have now started our development drilling at the SESB gas field offshore Turkey, which I'll explain more. The very strategic points for SESB is we own 49% of a large gas field that has been in production for many years and has a lot more reserves left, and also 49% of a very extensive production infrastructure that, if you had to replace it today, would be about 600 million. And we're just about 12 or 18 kilometers offshore Turkey. And the good thing is our 17 well gas program is fully funded, so we don't need any more capital. We started drilling, like I said, September 19th. We are the operator. We're in a very high gas environment right now, about $30 US an MCF. And you can imagine excellent economics there. There's a good opportunity for people to make a good investment because our shares are extremely undervalued, and I'll show you that. Turkey is a very good market for our gas. They import 90% of their gas, and 50% is from Russia. And there's also a big potential for future growth. So very quickly, here's a picture of Turkey, and here's our oil field to the south called Senderi. We basically produce that 100 barrels of oil per day, and that pays for all our op costs. Our main focus is SESB, and you can see it up on the top there, and that's where that natural gas field is. They discovered 8 gas pools. They only put 4 in production. So we're focusing now on putting the other 4 on. And then there's additional gas prospects. And here are some pictures of some of the existing infrastructure. One of the platforms, like I say, we have 4 of them, and this is our onshore gas field processing plant. So what are we doing here? This is a little, basically a photo or a diagram of the field offshore. The green little blobs are where the platforms are, and that's where we have existing production from. That is where we are still producing from. And the blue is the subsea gas tie-ins for the pipeline. And the 7 program A is the 7 discoveries which have not been produced, so they've been drilled, tested, mapped, but never put on production. Those are the little yellow pools there. And the concept, and we're doing it right now, is to directionally drill from the platforms to those discovered pools that have not been produced. And that's program A. And then program B are follow-up locations. Those are the red blobs. Again, most of those will be able to reach from the existing platform and produce into our facility. So all our money basically, well, it is not basically, it is going to go into drilling. There's no new money needed to increase the facilities or any pipelines. So for a quick netback here, as everybody knows, if they've seen my presentations before, I used the $8, $9 an MCF price. And what happened was we were doing this before COVID, and that was the price that we were getting. And we just carried on through COVID because we've always liked the price. At this price, it was economic, very good economics for this project. And but then the price increased, but our last reserve report and resource report were at the $8 to $9 deck price from the independent engineering firm that did the reserves and our resources. And you can see here that the NPV 10 at $8 to $9 is about 76 million US. That's our 49%. We're at $31 now. And so it's not just 3 times that value, because the first NPV 10 you see there, we've already removed a $30 million capex, whereas the other multiples won't. So now you're going to be upwards of $270, $280 million US, our NPV 10. And the same conversation with the exploration prospects. It was about a $93 million NPV 10, but that's at the $8 to $9 price deck. Again, it's at 31. It's actually increasing more. So now you're looking about another 300 million plus. So altogether, you're starting to talk 600 to 700 million NPV 10, and that's because of the high price environment for the 7 and 10 well program. Our netback is very high. We pay a 12.5% royalty. Income tax is corporate tax about 22%. And our OPEX is quite low because we pay a set amount per month, regardless of how much we produce. So if we're producing 15 million cubic feet per day, our OPEX goes down to about 11 cents to 21 cents an MCF. So you can see the economics are fantastic at $8 to $9, and so at 31 plus, they're completely stellar. Equity, it's a very boring picture right now. Basically, we've already done it. We've raised the money. We don't need any more money. We're going to be putting a well on every 45 to 48 days, and and that's almost instant production because we're just going to be tying into the existing infrastructure because we're doing directional drilling from the platform. And Program A will fund the $70 million of Program B. Again, this is just to illustrate, this is an $8 to $9 deck. So to keep the rig going is about $3.6 million a month. That includes the rig and all the sea surface equipment and people. So at $8 to $9 an MCF, by the time we finish Program A, we are making about $4 million US a month free cash flow. That's our interest. And that would be like 2023. But we're going to be 3 times that. So now you're talking, 12 million, 10 million free cash flow a month. So even when we start the first couple of wells, we start generating some very, very good cash flow because each BCF now is worth about $40 million there because we're getting between $30 and $40 for our gas. And in Program B, when we finish that, we'll be upwards of almost 8 million at $8 to $9 deck price. So we're going to be 3 times that. So this is our cash engine that will generate the cash to continue this program. And also you can see I have, there's a decline rate going out to June 31. We actually have it until 2041, this lease. And we can fill in the decline rate with new discoveries. But mainly what I'm talking about today is the Program A and Program B. So now my conversation is going to be basically changing a bit, because before it was always a company of we're trying to do, we can try to raise the money, we can drill these drill these wells. And September, we became a company that is doing. So we have all the long lead items that we had to purchase before. This is our shore base, pictures of our shore base. You can see the drilling pipe and the casing. And what they're doing is they're actually checking the threads on the casing. And we have all the equipment that we need for the 7-well program. And then as we progress, we keep adding to it, because things have like a 4-month lead items for some of them. We have the rig. We brought the rig out from Romania. So these are actual pictures of it. And I remember some of the conversations I had with the investors. They got a little, I wouldn't say upset, but a little concerned that we were delaying the moving of the rig. And the reason why we did it, because the rig actually came free in July 26, was because it was at the time to be re-inspected and re-permitted. So either we ship it to our place, SASB, and start the program, and then have to re-permit and ship it back, and then do it. We thought we'd get that done right away. And other comments people were kind of joking around is that Trillian picked up a rig that was not very good, and that all we're going to do is slap a little bit of paint on it. But even you can see that this rig is huge. Even slapping paint on it would take a long time, but it's all safe and ready to go. And here's the pictures of the rig actually now snugging up to our platform. And the reason is we're going to directionally drill, like I said, from the platform. And the reason for that, again, is because all money will go into the drilling. We can drill the well, complete the well, and within a matter of days, we're producing up the production casing right to the platform. These platforms are connected to our facilities by subsea pipeline. So any gas we produce, we will get the check by the 20th of the following month. And you can see that this is not a small rig. It's quite a large rig. And here is when they spudded our first well. Spudded means start drilling, and that was September 19th. So what are we actually trying to do here? What I'm saying is now we are a company that is doing. So here's just an example of some of the wells for Program A. And what you can see here is Akachoka gas pool. That's the pool that has been produced. And you can see the little round bleb. That is the circle we say is the platform. And the first well we're drilling is from the platform. And you can see the surface plan of it. And we're going to be going into the South Akachoka gas pool. To the east is the Gulak gas pool. And then to the west is the West Akachoka gas pool. And so we're going to do directionally drilling to the south pool. This is the actual plan of it. So we spent months, and we hired Schlumberger. They had a person in our office, because we're doing an extended long reach type drilling. And you have to get the trajectory right and all the friction and everything. And so we actually have Schlumberger's directional tool. And right now, this one here says 2,272 meters. We're actually at 2,500 now. The little diagram to the right, or sorry, the left, is your surface, your plan, and that's the trajectory of it going. And the one to the right is your subsea and your trajectory. And so we're already into the gas zones right now. And the important thing to let you know is this was the most challenging one. It's about 2.8 kilometers from the platform. And right now it's on budget, and it is tracking our trajectories 100%. And that's because we spent a lot of time to make sure that we did this right. And then we also now realize that we picked the right rate of penetration. It's about 11 to 20 meters per hour. And that allows us to actually steer the tool in the front quite accurately. And then just recently we put on the measured logging while drilling tools so that we'll be able to log the gas pay. So from the Akachoka platform, this just shows you we're going to do the Gulak gas pool to the right. South Gulak gas pool is almost done. We'll be TD that in about 5 days. We'll run a 7-inch production casing, perforate, and then we're also going to be recomplete Akachoka 3. So Akachoka 3, which is an old well, but there's some gas left in it. The new well, those 2 wells should go on production towards the latter half of November, and we'll get the revenue check the 20th of the next month. So from that platform, we'll do West Akachoka, Gulak, South Akachoka, and then recompletion. Then we'll move south to the other platforms and do the other wells. And then for Program B, a lot of it is second wells. So there's going to be a second well in South Akachoka, second well in West Akachoka, and then there's a northern component for Gulak and things like that. So again, from the existing platforms. And the reason why we're not putting in 2 wells at the same time is because it's prudent to actually get some pressure analysis so that you can tell that maybe you can drain the total reserves with 1 well instead of 2, and that way you won't overcapitalize. So this is the program for the reserves and the development. This is the one that has the large value, and direction drilling, cheaper, no new infrastructure, faster on production, and easier to work in the future. This is some of the upside on the block. And if you can see, here we go again, you can see the Akachoka discovery, the Gulak. There's a series of stratigraphic channel type deposits that have not been drilled. They have all the same characteristics of the gas-bearing sands that we produce from. And I have 13 of these. And we're going to end up testing one of these probably in Program B. And in my experience, they will produce as much gas as all the structures together. And that'll that'll get rid of that production decline that you have there. So our shares right now are about 41 cents Canadian, which is severely undervalued. We have the analysis by Bill Newman from Research Capital that gives it about $1.35 based on 2024 debt balanced or net revenue, and that they lowered the price to about $18.50, but it's $1.35. The new net present value gives us about 700 million US, or 984 million Canadian. We have about 374 million shares out, fully diluted, about almost like 500 million. So again, you should be $2. Our expected cash flow based on our own modeling for 2023 should be about 100 million. 2024 should be 140 million. So you can use 3 or 5 of that multiple. At $30 an MCF, our gas is worth 1.2 billion. So again, quite high. And it just shows you that before, like I said, we were a company going to do. Now we're a company that's doing. We're in the process of drilling these wells. So now is the time to actually get the shares, because the share value is going to start increasing when we start testing these wells. So the conclusion, I wanted to wrap this up pretty quick because I wanted questions for people if they have them. So we basically have a fully funded 17-well program, which are a conventional gas deposit in a high-price gas environment and Turkey will buy all the gas, low op costs, and as you know, everybody wants to reduce the dependency on Russian gas, and so this is a very, very good project with a lot of future gas and revenue potential, and we're going to use this actually to generate revenue to do other projects. So that's about it quickly here.
Great job, Art. We do have some questions for you. Let's jump in. Brian O asks, how much gas will be placed in production after each well is drilled?
So so the wells will test between 7 to 1 million cubic feet per day, and I'm not talking 100%. And so what we'll end up doing is we will put the wells on and we'll base it on the reservoir engineers' expertise, between 4 and 5, maybe 6 million cubic feet per day. Probably. So our half will probably, I would say probably 5 million cubic feet per day per well. We'd put it on.
Tommy N wants to know, what's the status of the Vranino project, and what are you doing to ensure the project is active and on track to be exploited?
So that's the one in Bulgaria, and what we're doing right now is I've had the board form the committee with the board, and the board is looking at how to best proceed with that. It's a very, very good project. It has a longer time period before we can actually start generating revenue from that one. And the other issue is that there was a recent election in Bulgaria, and it's the same government that had put in the fracking bans a few years ago. So we're actually looking at that, and that's about all I can say. We don't want to get rid of it because it has a large in situ, gas volume, but we need to make some smart business decisions on that.
That makes a lot of sense. Curtis H wants to know, what risks, if any, does the expanding conflict in the region present to the company directly or indirectly? And could acts of sabotage upstream negativity affect cash flow or getting the new production to market?
So if there is an escalation of the conflict in Turkey, we would have a world war, because Turkey is part of NATO, and you've heard that every inch of that territory is going to be protected. So the conflict will not proceed into Turkey. Also, our property is only about 12 kilometers offshore, and I don't even remember the map. We're in a little embayment. And then for the infrastructure, the pipelines, the platforms, the facilities are all owned, 49% of us. So we don't have any concern about sabotage because it's just too close to the shore. And then our sales line is at the edge of our onshore facility, and it's in Turkey, and it's part of the distribution system of all of Turkey. So I do not see that as a risk. The only thing I see is that if there's more escalation by less gas coming out of Russia and so on, there will be just a really more squeeze of supply, and the price of the gas will continue to go up.
Another similar question from George Koletsky. How safe is the drill rig during this conflict? And do you feel the prices of natural gas, they're sustainable at these levels for the next year or two?
The rig is safe because, again, like I say, it's part of NATO, and Turkey actually has a very large armed force. Like they're not a small country. And for the price, it might not be $30-$40 for many years. I see that it's going to be $30-$40 from the winter, so from now until potentially the summer when you have the heating season and so on. And if it goes down, it'll go down maybe, I don't think, below $18, $20. And that's because there's still a supply crunch in Europe. They filled some of their reservoirs, but there's conversation or talk is how are they going to fill it next year? Because the supply crunch is still on. There's not enough LNG terminals. And then all that being said, you got to remember that we looked at this at $8 to $9, and we're happy. We were happy with $8 to $9, and that's the reason why we came out of this whole storm drill ready with all these locations, because we were going to $8 to $9. So we went through COVID. We had some pretty tough sledding, during that time, but we got the equipment, we got the rig, and then we came out drill ready at this high price, this high gas price environment. So we're not too worried about the price. And even if we get 6 to 8 months or a year at $30 to $40, it pays all the drilling capex. So now we basically have all the costs repaid.
Scott Hallenberg says he appreciates the Friday updates on the status of the drilling, as well as the national news that pertains to natural gas. So he's just giving you some props there. Richard Grimsley says, how close to total depth? That's his question.
So we are total depth right now. We're probably maybe 200 meters and excuse me, but 400 meters measured depth, but we're already into the upper gas sands right now.
Okay.
So we should be there. We're drilling about 150 meters a day. So we should be there with them 3 or 4 days.
Marco Hockmeister says, how you mentioned the 4 existing platforms are producing. So what is the current volume, against what price, and when did this start?
Yeah, so these wells started producing in 2007, and there was another series in 2011. And we're only producing, our net is maybe 200 MCF a day, which seems like not too much before at $8 to $9, but at $30, it actually pays a lot of the OPEX. But the reason why we kept it running was because we always intended to drill the new wells, complete them, and put them on production right away. If we had shut in the facilities and the pipelines and everything, it would have taken us maybe 2 or 3 months to start it up again, because you have to clean the lines. There's always little issues. And this way, we were losing a little bit of money maybe a year ago, but now we're not losing any money, and we just keep things running, which is a good business. So we're not making much. Excuse me.
Okay. Richard Grimsley wants to know, is the first check November 20th or December 20th?
It'll be December 20th, and I'll see if they can get a photocopy of it, and they'll send it to people. Okay.
And Frank Mason asks, is the onshore facility being upgraded for maximum natural gas?
Yeah, so it's rated right now for 75 million cubic feet, and we won't get above 35 to 40 million cubic feet in the short term. And if we start bringing on some of the exploration, we just have to change out one compressor that is about $1 million, but is well worth it because of the price of gas. And we still will not get up to 75 million cubic feet per day. The only option that we might do is that if we do some exploration off block and we find some larger targets, then we would run a spur to our existing line, and then we could upgrade the onshore facility to 150 million cubic feet per day.
Great. We have 3 questions from Ernst Schonbachler. 1, who is the operator of the gas field?
So we operate the drilling, and so they signed over the operatorship for the actual execution of the drilling, because we have the expertise for this water depth, and we also have really good directional drilling people. To the TPAO, our 51% partner, operates the actual production. So they operate when the gas is being produced. And the reason why we do that is we pay a set fee. It's about $120,000 to $102,000 US a month. and that works for us because that doesn't matter how many people are hired for the production, part of it. We pay a fixed fee, and TPAO actually are very good operators, and that's why we can still operate at about 200 to 400 MCF per day because we are producing at a very low production pressure. So they have really good expertise in operatorship for production.
Great. The second question regarding your partner, I believe you said TPAO. Have they been fully financed?
Yeah, so what we do, because we operate, we do cash calls. And so we've done our first cash call and it's been paid.
And can you dispose freely of the future cash flow?
Can I what? Sorry?
Dispose freely of the future cash flow.
So at this moment, yes, we can, because the cash is basically we're going to be putting it back into the ground and developing it, developing the gas and so on. And then after that, we'll be able to, and the reason for that is we have to, all the rigs and everything that we get, we have to pay in US dollars outside of Turkey. So we have to be able to convert it to US dollars to pick up all this stuff. So no, that's not an issue.
Okay. And Frank Mason asks, can TCF be 100% of SASB?
Can TPAO be 100%? Yeah, no,
he says TCF.
No. So we've tried many times to purchase this field, and we also tried to go sole risk. And TPAO, this is a very important field to them, and they will not divest of it.
Okay. Got a few questions from Mike S. Roughly how much will each gas well deliver in terms of USD monthly, assuming $31 per MCF? So
it's 1,000 MCF per million cubic feet. So that's $31,000 per MCF. So you're talking, $70,000 a day per well.
And what is your biggest challenge as a company now that your capital needs are solved?
I would say one of the biggest challenges I'm finding right now, and it's not a negative, is actually to stay focused because we're now having this project going, we're actually executing it, and there's a lot of news about it. We get a lot of opportunities from other companies coming across my desk to take a look at. And some of them look really good, but I just got to stay focused.
And lastly, do you have enough production to lock in long-term supply contracts?
So Turkey just started here last week, allowing hedging and long-term contracts in Turkey. But that's for price setting. Right now, we have a buyer who will buy all the gas, and it's a take or pay situation. And they will take as little or as much gas as we can produce. I'm the one that's not comfortable in hedging, but again, that's a conversation I've turned over to my board of directors to give me some direction.
Bill Bifford states that we investors assume the integrity of the undersea pipeline has been inspected, approved, and ready to deliver gas when necessary. So how long do you expect to receive $30 per MCF? And do you think we could exceed 40 USD per MCF this winter?
So the pipeline has always been being used for production. So it goes through its normal inspection and maintenance because they're active, like we actually produce. So it's never been shut in. And the answer to the second question is yes, I think we're going to be upwards of $40 before the winter is out.
And a follow-up from Bill is, at what point would Trillion consider a share buyback?
Again, like I always said before, if I'm producing and I'm making, $20 million a month and upwards of that, that doesn't even have to be $20 million. And I feel my share value is not what it should be, and I look at it and say, okay, I can maybe add a well, and this is what it'll do to my share value. Whereas I can go on the market there and buy back a bunch of my shares, and so I'm not adverse to doing that. like I will do whatever makes the best business decision.
I don't know the name of this person. What is the status and plan for the Bulgarian asset as of now?
But like I said, what we've done is we've gone back and I've turned it over to the board. I actually have a meeting tomorrow on a Zoom call to find out where the environmental impact study is at this time, what has to be done with the consultants that we did it. So we're still in the evaluation stages. We were looking at farming it out or having a partner, and that could be another avenue. But that's all I can say about that.
Jason Martin asks, do you plan off-block exploration? If so, do you feel you can compete with the major companies that will be involved in that exploration and production?
Yep, that's the answer. So I actually have to apologize. I have to go because I have another call, another presentation.
No problem.
Yeah,
we understand. We just wanted to get all those questions in, but we'll send the questions to you, Art, so you can answer them directly. And thank you so much for joining us on our conference again.
Okay, and I really appreciate being here again. Thank you.
Safe travels to Turkey.
Yeah, okay, yeah, bye.
Okay, everyone, stay with us. We'll be right back in just a few minutes.